The Companies Act 2006 requires that a dividend must only be paid if there are sufficient distributable profits. In some cases, the bank account may be in credit, but the company still needs sufficient retained profits to cover the dividend at the date of the payment. Profit, in this instance, is defined as being accumulated realised profits. A dividend would be classed as ultra vires, which means illegal if it meets any of these criteria. The dividend is proven to be more than the sufficient retained profit amount. The dividend is made out of capital. The dividend is paid when there are losses that exceed the accumulated profits. If you have a private company, there is no need for full accounts to be prepared to prove sufficient profits in the calculation for an interim dividend. However, you must provide the calculation in the accounts for the declaration of a final dividend. HMRC's Corporation Tax Manual states that the accounts need to be detailed enough to enable a reasonable judgment to be made as to the amount of distributable profits, as at the payment date. Before any dividend payment is made, the financial status of the company must be considered. The test must be satisfied immediately before the dividend is declared, and this is generally interpreted to mean that the net assets test must be satisfied immediately before any company directors decide to pay the dividend. A lawful dividend is when the directors correctly prepare basic interim accounts and a dividend is paid based on those accounts. This is the case even if the final annual accounts that are prepared at a later date show that there was an insufficient amount for distributable profits. If your business withdraws regular amounts via dividend and the management accounts show a trading loss or the profit cannot support the payment, these amounts would be deemed as illegal. HMRC would argue that in the majority of such cases, the director and shareholder of a close company will be aware that the dividend payment was illegal. The main consequence of paying illegal dividends could arise if the company goes into liquidation. When a business goes into liquidation, a liquidator or an administrator will review the director's conduct over the 3 years before liquidation. If the director is found to have paid a dividend illegally, then the shareholders will be expected to repay the amount unlawfully withdrawn under the Companies Act 2006. HMRC are often the largest unsecured creditor of many businesses in liquidation, so they will actively pursue this route. The Insolvency Act states that, as a director, you can be held personally liable for any breach of fiduciary duty to the company. Even if you are not liquidating your business, HMRC could open an inquiry at any time into the treatment of a dividend. HMRC treats a dividend that it perceives to be illegal as being the equivalent of a loan, and for a close company, this means being a loan to a participator and must be declared on the company tax return and could be subject to Section 455 tax. If a loan isn't declared and the financial statements filed with Companies House show that the company's reserves are in a deficit at the end of the relevant period, HMRC may investigate. Similarly, where the opening balance next year is in a deficit but dividend payments are still paid out. In some cases, HMRC have been known to argue that the repayable amount is an interest-free loan. For a director-employee, this could result in a taxable benefit in kind should the loan be less than £10,000. Therefore, please make sure that you're paying dividends correctly to avoid any problems at a later date. If you'd like to know more, please get in touch with us. I hope that's useful. If you'd like to see more videos where we answer lots of questions on tax and accounts, take a look at our YouTube channel. You can also subscribe for more videos.